As an analyst at WB Corporation, you are evaluating its employee training program for the current year. Management has announced that it intends to invest 1.5 million in the employee training program. The incremental net cash flows are forecasted to be 120,000 per year in perpetuity. WB Corporation's opportunity cost of capital is 7%. As judged by the NPV rule, will WB Corporation's employee training program benefit the shareholders? Select one of the three options. So what we simply have to do here is to calculate a NPV, and we know that NPV is nothing but present value of all the inflows minus present value of all the outflows. Now every year we are expecting to receive 120,000 in perpetuity. So present value of all these cash flows would be 120,000 divided by 7%. So on a financial calculator, this is your 120,000 divided by 7%. That would give us 1.71 million. And how much are we investing? 1.5. So this is 1.5 million, which would give us a positive NPV of 214,000, and therefore the answer is yes. Next question. Using the information given in the previous WB Corporation example, where the initial outflow is 1.5 million and the cash flows are 120,000, determine the internal rate of return. Determine the internal rate of return using this data. So for internal rate of return, what we know is that present value of inflow has to be same as present value of outflow. We know that our outflow is 1.5 million and the inflows are 120,000. So what is that rate at which you discount 120,000 in perpetuity so that you get 1.5 million, which would simply mean that this IRR is equal to 120,000 divided by 1.5 million, and that amount would be 8%. So this is the correct answer. Should we move on? Chocoholic Limited is considering whether or not to open a new manufacturing plant in Australia. The project will require initial investment of Australian dollar 2 million. So this is your initial investment. The plant is expected to generate Australian dollar 500,000 for next 8 years. It has a cost of capital of 10%. Determine if the project is beneficial using NPV rule as well as the IRR rule. So NPV you can calculate by simply saying present value of inflow minus present value of outflow. Present inflows are 500,000 for 8 years, discounted is 10%. So again on a financial calculator, second clear TVM, in fact second beginning, second set, second quit, shifting to end mode, 500,000 would be payment. Discount rate is 10%. So 10 would be IY, 8 would be N, compute present value. That would give us 2.66 million and your initial investment is 2 million. So making this number positive minus 2 million. That would give us a positive NPV, and the very fact that NPV is positive, we know that IRR has to be more than cost of capital, and therefore the correct answer in this case would be yes. Next question. Project A and Project B are two mutually exclusive projects. We have their cash flows, we have IRR, and we also have NPV at 10%. As an analyst, which is the project that you would like to invest in? Yes, so we know that in this case IRR is higher for A but NPV is higher for B, and NPV is a more superior method. Therefore, we will go with project B. No, it says mutually exclusive, so we cannot select both. So we'll select the one which has got highest NPV. An investor buys 2 shares for 120 pounds each at time 0. At time 1, she buys 3 more shares for 135 each. At the end of year 2, she sells all the shares for 150 each. During both the years, the stock pays dividend of 5 pounds per share. The time 1 dividend is not reinvested. Calculate the money weighted rate of return for this portfolio. So what we know is that money weighted rate of return is simply the IRR of the portfolio. So we will build a small timeline to solve this. This is time 0, this is time 1, this is time 2. We have bought 2 shares of 120 each at time 0. So the amount of investment would be minus 240. Then 3 shares of 135 each. So 135 into 3, the amount of investment would be 405. At year 2, we have sold. So this is where we purchased 2 shares. This is where we purchased 3 shares. So we are going to sell all the 5 shares at 150 each. That means we will receive an inflow of 750. At time 1, we received dividend of 5 per share. So total dividend that we must have received was 10. So our net outflow would be negative 305. 395. At time 2, we must have received 5 per share on 5 shares. So that would be a dividend of 25. That would give us 775. So now on your financial calculator, using the cash flow function, press cash flow, then say second and clear work. At time 0, the amount that's invested is 240 negative, enter. At time 1, 395 negative, enter. And time 2, 775, enter. Press the IRR button and then say compute, which would give us 15.35. So this is your correct answer. Moving further. Seems like a really big question. Rockefeller Corporation sponsors a pension plan for its employees. In fact, we should read the last line first just to get an idea. Find the time weighted rate of return for both in-house and fantastic services. So this is what we would be expected to calculate. Time weighted rate of return. Rockefeller Corporation sponsors a pension plan for its employees. It manages part of the equity portfolio in-house and allocates the management of the balance to the fantastic services. As Chief Finance Officer of Rockefeller Corporation, you want to review the performance of in-house and fantastic services portfolios over the last 4 quarters, so that's 1 year. In the table below, the ending value is the portfolio value just prior to cash inflow or outflow at the beginning of the quarter. So this is your ending value, okay, and we can see that ending is also the beginning of next quarter. The amount invested is the amount each portfolio manager is responsible for investing. So now these are the values we have, and we have to calculate time weighted rate of return. So how do we deal with this? See, read this carefully. There are 2 separate portfolio managers, one which is in-house and the second one which is being outsourced to this company, Fantastic Services account. We want to compare their performances. In quarter 1, we started with 5 million. Then at the beginning of the period, there is an additional investment of 1 million. So total amount that the manager could invest in that quarter was 6 million, and by the end of the year it has been 7. Next quarter, there was a withdrawal of 500,000 and therefore amount available for investment was 6.5 million, which became 6.775. So what we know from this is that the amount that we are really concerned are these amounts. That he invested 6, it became 7. He invested 6.5, it became 6.775, so on and so forth. Time weighted rate of return is nothing but geometric mean of all the holding period return. In this case, it is 4 quarters, that means 1 year. So we don't have to put it in under root. So how to calculate geometric mean? 6 became 7, so that's a holding period return of 7 by 6 into 6.775 divided by 6.5 into 7.72 divided by 7 into 7.12 divided by 6.508. So let's do it together. On your calculators, 7 into, I'm just multiplying the numerators, 6.775 into 7.72 into 7.12 divided by 6. Yeah, it should have been the other way around. My mistake, I'm so sorry. 6.508 divided by 7.12. Yeah, so I might have to do it again now. 6.508 into 7 into 6.775 into 7.72 divided by 7.12 divided by 6 divided by 6.5 divided by 7. That would give us 1.23. So 1 rupee must have become 1.23. That means time weighted rate of return would be 23%. I think I am short on number of decimals. 22.58. Okay, so the lessons learned is to increase the number of decimals, which I'm going to do now. Second format 9, enter, second quit. Let's do it for Fantastic Services now, the other one. So 13 becoming 14.2, so that's 14.2 divided by 13. 13.24 again divided by 13. 6.6592 divided by 6.24. 6.469568 divided by 6.259200. So again on a calculator, 14.2 into 13.24 into 6.6592 into 6.469568 divided by 13 divided by 13 divided by 6.24 divided by 6.2592. That would be 1.2271. So it should be 22.71. So the correct answer is 22.58 and 22.71. Should we move on? Next question. On January 1, 2010, Star Fund has a market value of 200 million. During the period 1st January to 30th April, the stocks in the fund showed a capital gain of 20 million. Let me read the last line. Okay. So what we need to find out is time weighted and money weighted rate of return. On 1st May 2010, the stock in the fund, so 1st May would be the next day. So technically the same date, 30th April and 1st May. The stock in the fund paid a total dividend of 4 million. So see what's happening to us. We have started investment with 200. Then by April we've got capital gain of 20 and we've earned dividend of 4. All dividends are reinvested in additional shares. That's interesting. Because the fund's performance has been impressive, institutions invested additional 40 on again the same day, 1st May, raising the assets to, so 200 plus 20 to 20 plus 4 to 24 plus 40 to 64. On 31st December, so end of that year, it has received total dividend of 5.28. The market value not including 5.28 is 280 million. The fund made no other interim cash payments. So kind of a complicated question. Let's build a clean and smooth timeline to understand this. So let us say this is January. This is your May, the 1st of May or closing of April. This is your December. We have to calculate both time weighted and money weighted rate of return. This is where the amount that's being invested is 200 million. During the period 1st January 2010 to 30th April, there is a capital gain of 20. So we have plus 20 as capital gain. Original 200 is already there. Plus we have received dividend of 4. So the amount to which your portfolio has been able to grow is 224. Now what we have also received on that day is a new investment of 40. So your closing portfolio is 264. However, the return that we have been able to earn in this period is only 200 to 224. It is not 40 because that's additional contribution to the portfolio value. Now once you have a total portfolio of 264, by the end of the year it has become 280. Plus we have also received dividend of 5.28. So how do you solve time weighted rate of return? Straightforward, you simply have to calculate. You have to calculate the geometric mean of all the holding period returns. The first holding period return would be 200 to 224. So 224 divided by 200. This is your first return. The second return 264 to 285.28. So 285.28 divided by 264. Multiply the two. 8 point. So multiply these two with each other. Okay, let's do it together. 224 into 285.28 divided by 200 divided by 264. That would be 1.210. So time weighted rate of return is 21.03. Are we fine? Next question. Suppose a T-bill with face value of 100,000 and 180 days to maturity selling at 97,500. What is the bank discount yield? So we know that bank discount yield we always calculate on face value. So we are earning a total return of 2,500 on an investment of 97, but denominator for bank discount yield would be 100,000. And annualizing it using 360 days. So into 360 by 180. So that's 2.5% into 2. That would give us 5%. Next question. The bank discount yield on a T-bill with par value of 100,000 and 150 days to maturity is 4.8%. What is the dollar discount and purchase price of the bill? So just simply using the formula of bank discount yield, the dollar amount of discount as a ratio to face value, and then this amount we are going to annualize. So into 360 divided by 150, this is 4.8%. Dollar value is what we need to find out. Face value is, so this is dollar discount divided by face value of 100,000 into 360 by 150. This is 4.8, and just moving around with the equation. So 4.8 into, now 150 would be in the numerator on the other side, divided by 360. Did we do 365? Yeah. 4.8 into 150 divided by 360. That would give us a discount. Did I use 365? 4.8 divided by 360 into 152. So dollar discount divided by 100,000 is 2%. That means dollar discount is 2,000. Therefore, purchase price is 98,000. Phew. Next, treasury bill with face value of 100,000, 90 days until maturity is selling for 98,500. What is the holding period yield, bank discount yield, money market yield, effective annual yield? Holding period yield is same, so we need not calculate that separately, assuming the question is done correctly. These values are different for all the options. If you can solve for bank discount yield, then you have a direct answer, and bank discount yield is relatively easy to solve. We have a holding period yield of 1.52, sales price is 98,500, so that's 1.5 on the face value of 100,000 multiplied with 360 divided by 90, so that has to be 6%, and therefore this is the correct answer. So we need not solve the remaining yields. Next question is not